Good afternoon. This is Phil Perlman, Stocktwits executive editor. I'm down here at the NYMEX, joined this afternoon with Mihir Dange, co-founder of Graphite Capital. Mihir, how are you today?
I'm great. Thank you for having me.
Great to have you here. So you're trading gold, and how are you leaning presently into the FOMC this afternoon?
Right now we're trying to stay as flat as possible, but we're looking at kind of pivot points, and we're seeing 1261 as a good pivot point. We kind of traded up there today, backed off from there, so we're using that as a pivot point. 1276 is another pivot point, and to the downside we're looking at 1250 and 1201.
So you're basically laying out ahead of the minutes,
Right.
just not to be affected by any huge move one way or the other.
Right. I think right now you're seeing a tug of war between technical bears, because the chart has been severely damaged, severely broken, versus shorts. There are lots of shorts in the market, record amount of shorts that are covering at these prices as we consolidate. Over the last week or so, we've consolidated kind of in a $50 range. And because you're seeing that consolidation, you're seeing the shorts cover over the last few days.
So you're seeing a lot of short covering, but you're not seeing a huge bounce back?
Right, exactly. I mean, we traded 1276 last Thursday, 1176 last Thursday. On Friday we traded 1210. So we've been between 1210 and 1270 for this whole week, and I would imagine we're probably going to stay in that range.
Are you surprised at all by the inability of the market to just come in and buy it after it got killed so much?
A little bit. Usually you see a strong dead cat bounce, and the fact that we haven't really seen a dead cat bounce may allude to the fact that we are bear flagging and we may see lower gold prices over the next coming weeks.
Now let me ask you this. If you were bullish, right, how would you express that in the market presently?
I think the best way to take advantage of the precious metals market right now is, if I wanted to play this from the long side, is to get involved in silver. The silver-gold relationship at its peak was 30-1. We're looking at it today at 65-1, which we haven't seen in almost years. And to me, that means that silver is a much more attractive investment if I want to take part from the long side. I think that ratio should be closer to somewhere around 60-1. And when you see this market rally, and it's a when, I mean, you might see downward pressure first and then a big up move. But when you're ready to participate, I think silver is the commodity that you really want to do it in.
So it'll outperform when we move higher. And speaking of that, just backing up the lens a little bit at a more of a macro picture and a more longer term picture looking out. We've had huge pressure. I mean, it's been almost 2 years now. We got up over 1,800, and now we're down here in the 1250, 1260 range. What do you see going out 6 months, 1 year?
I mean, that's a good question. I think let's talk about what got us here, right? If you look at QE 1, 2, and 3, there was a lot of money being pumped into the system. So you saw a lot of money being pumped in. You saw a weaker dollar. You saw stronger currencies across the globe, and you saw commodity prices rally very hard because of a weaker dollar. Now we're seeing the talk of tapering. There really hasn't been a dollar that's been pulled out of the system yet, but the emotional aspect of the fact that there will be tapering is pricing all of this in. So you're seeing a stronger dollar. You're seeing bond yields. 10-year bond yields go from 2.1 to almost 2.7. It's like at 2.65 today. So bond yields are increasing, and you're seeing the yen and the euro not outperform the dollar. And so you're seeing weaker commodity prices. Now, from here in, the real question to me is what happens to rates. And I think if the bigger picture is you're going to see higher bond yields in the 10-year, they go up to like 3%, you're going to see lower gold prices. The asset rotation out of gold is what has taken place till now. Now, will that continue? I don't know. Will people say this is it's a cheap commodity right now? I don't know. But there are other markets that are outperforming gold right now. The S&Ps, bonds,
everything.
Everything. I mean, crude, platinum, copper, you name it. right? So all these assets are outperforming. It just makes it worthwhile for people to be involved in those instruments.
And one last question regarding yields and the rates. You watch those very closely in relation, and the dollar, of course, and Forex markets. You never know a bottom until after the fact.
Of course.
And it looks like, and everybody's talking like, and the tapering talk, that yields have bottomed. And this has been a bear market in yields and a bull market in bonds that is epic, right? 30 years or whatever.
Absolutely.
You think we bottomed here?
I mean, I think we have to have bottomed. And the reason I think that we have to have bottomed is the reason the Fed believes that they can start tapering is because the economy can slowly and organically grow on its own. And to me, that means because it is capable of doing that and rates have kind of stabilized, at some point, there is a need to curb inflation. We've seen inflation over the last 2 years or 3 years increase, but increase in only consumable goods, gas, crude, milk, anything that is consumable. That's where we've seen inflation. So at some point, in order to curb, PPI and CPI numbers, we have to raise rates. And Ben Bernanke said in the last time he spoke a month ago, he felt rates were fairly priced around 2%. Inflation is priced around 2%. So to me, it means they've said they want to keep rates low, but it's definitely on their radar. The Fed funds rate have to go only one way right now, and it's up.
Mihir Dange, thank you so much for joining us today.